Okay, good morning friends. Okay, let's start with a new area today. So last class we are done with capital budgeting. I have to give some summary notes, I'll give that later. I'll start with a new area which is cost of capital. Now when we started with, just a minute. In the introduction, when we started with the main role of CFO. What is a CFO required to do? Somewhere we talked about these two things: investment, financing. Investment and financing. These were the two critical parts which we discussed. I gave an example stating that should we raise money first or should we invest money first? We finally concluded that both have to be together. When you do your investment decision, you go through step 1, 2, 3, 4 and finally calculate NPV. NPV was the decision you used to take, and NPV if positive you used to go ahead, NPV if negative you used to reject. Now to do that NPV calculation you needed 4 columns: year, cash flow, PVF and DCF. The year and cash flow used to be given in the question, we used to calculate and get it, but that the discount rate what we have been using till now is called as cost of capital, and that cost of capital comes from financing. The financing decision will tell you what is the cost of capital of that finance. So if I am putting 5 crore rupees in a project, that 5 crore has come at 4%, 6%, 8%, 10%, 12%. That calculation is going to be done through financing decision chapter. So investment decision, the objective was to maximize NPV. You can maximize NPV by minimizing cost of capital. Lower the discount rate used for discounting, better will be the NPV. When we get one positive NPV, we used to increase the rate to get negative NPV. Or from negative to positive, we used to proceed in this order. So always what used to happen is, if there is a 10% discount rate and 12% discount rate, 10% discount rate will give you an NPV of 50 lakhs. 12% will give you only 40 lakhs. So as we increase the discount rate, what used to happen, or as we reduce the discount rate, the NPV used to get impacted. So the NPV will always get impacted with an item called as discount rate, and the objective of any company would be to minimize the cost of capital. When I am giving a loan, your objective would be to take the loan at lowest possible rate. Given an option of 10% or 12, 10% is nothing but the interest rate. Technically, it's like a interest rate. 12% is also like a interest rate. So the objective of any company is to minimize the cost of capital. So that is where these two decisions work parallelly. Investment and financing has to go hand in hand. It can't be investment separately, financing separately, because you do investment decision analysis, you're assuming 8% rate. Positive NPV. Finally, when you finance it, it comes at 12%. The project will get rejected, because your investment and financing has to go hand in hand, because the cost of capital is one critical parameter in deciding whether a project is to be done or not. Because cost of capital can lead to acceptance of a project, it can also lead to rejection of a project. So one critical parameter in my analysis is the cost of capital, and that number is going to come from only one item called as financing decision. My financing decision will kind of let me know what is the discount rate to be used, and that is indirectly going to help us in finding out the NPV. Now when it comes to financing, I take it forward. Now when I talk about financing, there are various forms of capital which you can take the intention. There are various forms of capital which are there. Now, when I explain the term capital, in accountancy, you would have understood the term capital to be equity share capital. When it comes to finance, the capital means long-term funds. The term capital means long-term funds, and there are 3 types of long-term funds: equity, debt, preference. And our first part of the problem, the first part of this chapter is going to focus on all of these 3: equity, debt and preference. To an equity shareholder, I give equity dividend, ignored in my cash flow calculation. To a debt holder, I give interest, again ignored in my cash flow calculation. To a preference holder, you'll give preference dividend, again ignored in cash flow calculation. That is basically reward exclusion principle. What the principle said was that you ignore it in step 1, step 2 and step 3. All of this will come in step 4 as cost of capital. It will come as a single item called as cost of capital. So the term cost of capital refers to the cost of the entire capital structure of the company. Single cost for the entire capital structure of the company. The term capital means equity, debt and preference. So how are we going to do about all this calculation? You are going to see now. In that, the first thing which we start is debt. The first starting point is debt. Any doubts till now? So investment decision, financing decision parallelly has to work in any scenario. You cannot be doing investments without analyzing financing. You cannot be doing financing without analyzing investment. So both work hand in hand. The purpose of investment decision is to maximize NPV. The purpose of financing decision is to minimize cost of capital. When I minimize cost of capital, it automatically leads to maximization of NPV. Clear? Any doubts till now? Now, let's start with debt. When I start, all of this is there in the theory part. When something is to be noted, I'll let you know. So debt, there will be two types of debt. Redeemable, irredeemable. Now, I think there are certain restrictions in Companies Act which doesn't allow irredeemable debentures. So whatever it is, from a problem solving point of view, because it's not specific to India, it can be in any country. So we learn about redeemable debt and irredeemable debt. There are two types of debt. There is a redeemable debt and there is a irredeemable debt. In an irredeemable debt, when will I get back my principal? Logically speaking, I'm not expected to get back my principal. I'll keep getting interest every year. That is the expectation unless the company gets wound up. That is obviously there.
Friends, I got your feedback on those who are attending auditing. I got your feedback. We are in the process of changing the auditing faculty so that it will be better for you. We take it very positively. I had shared it with DJ also. We take it very positively, and but just give us a week's time so that we change it. Okay. For those who are doing exclusively group 2, tomorrow you will not have any class. Exclusively group 2. Tomorrow you will not have any class. Your accounts class will be next week, Monday, Wednesday, Friday. Okay, Monday, Wednesday you will not be having auditing. Within a week's time I will set it right, Monday, Wednesday. For those who are doing group 1, also tomorrow we will have a long session of taxation so that we will be completing PGBP and walking into capital gains tomorrow. Okay, that is the schedule for tomorrow. That is the alteration. Okay. Thank you.
Okay. Now, we have an irredeemable debt. The nature of an irredeemable debt is that you will keep getting interest every year. Interest is something which will be paid every year, but you are not required to pay principal. So this becomes a nature of a perpetuity. Why perpetuity? I don't see any end for this. Do you see an end for an irredeemable debt? Theoretically, no. Irredeemable debt is expected to have perpetual life. So it is kind of a perpetuity. For a perpetuity, what is the formula for present value of perpetuity? Present value of perpetuity. Present value of perpetuity equal to perpetuity amount divided by, technically called as time value of money or your interest rate, whatever way you want to call it. Now I swap this formula, or let me call it as interest rate itself. I swap the formula, it becomes interest rate equal to perpetuity amount divided by present value of perpetuity. Interest rate is technically called as KD, cost of debt. Technically called as KD, cost of debt. Perpetuity amount is technically called as interest. Every year you will receive interest. This is in rupees. Present value of perpetuity is nothing but net proceeds. What is net proceeds? I'll explain, but basically the money which you are going to get. Net proceeds is technically the money which we are going to get. So cost of irredeemable debt is equal to interest divided by net proceeds. Some alteration will be done. I am coming to the alteration. Interest divided by net proceeds. The alteration is into 1 minus tax rate. Interest is a tax deductible expense, PGBP. You will learn that interest is allowable as an expense for income tax purpose. So that is why it's interest into 1 minus tax rate. The basic rule is your cost of capital has to be post-tax. Why? All your cash flows are after post-tax, CF80. When you do your step 2, you deduct tax and do it. If you are not deducting tax, then cost of capital will be pre-tax. Then both can be pre-tax or both has to be post-tax. Ideally, we consider both as post-tax. We do not work with any pre-tax number. So the formula is interest into 1 minus tax rate divided by net proceeds. I'll let you know if at all something is to be written. Interest into 1 minus tax rate by net proceeds. Any doubts on the formula? Now comes the redeemable part. In the redeemable part, is there a life? Yes. So after some years, I am going to get back the money. So what they say is interest after tax. This is my first expense, all from company point of view. Okay, they are only interest after tax. Here interest after tax plus average other expense. What is average other expense? I am just going to explain. Plus average other expense divided by average funds employed. I'll explain each of this. What is average other expenses? Today I collect 100 rupees from you. Today I have collected 100 rupees from you, but after 5 years I'll pay 110 rupees. Premium on redemption. I have to pay you 110 rupees. Or today I collect only 95. Why 95? 100 was the issue price, but 5 rupees went in flotation cost. Because there is an expense associated with the issue, underwriting commission, all of that has to be paid. So I did not get 100 itself. You paid me 100, but when it came to me, it came as only 95. 5 rupees went where somebody in between the issue expenses are there, somebody is taking money. So net I got only 95. Now my average other expenses, redeemable value minus net proceeds divided by balance life. Why balance life? I'll explain later on. As of now, let's just understand this. What is redeemable value? The value at which you redeem the debentures, which is 110. What is net proceeds? What I can collect today. You paid me 100, but I did not collect 100. I got only 95. 95 is my net proceeds. So 110 minus 95 divided by 5 years. In short, apart from interest, every year I am paying you extra 3 rupees. Every year I am paying extra 3 rupees. Why extra 3 rupees? Because you gave me 95 and getting back 110. You gave me only 95, but you are getting back 110. All this analysis is from company's point of view. Nothing is from us point of view, not from average funds employed is average of this 110 plus 95 by 2. Average of redeemable value and net proceeds. Average of redeemable value and net proceeds. This is called a shortcut method to the answer. You want the exact answer, then we have to do IRR, internal rate of return. I'll get a cash flow and then calculate IRR. I'll show in one question where I get the IRR also. IRR is the exact answer. If somebody wants to know the real answer, it's IRR. But this is an approximate answer and this is what we use. So for irredeemable debt, interest after tax divided by average funds employed. For a redeemable debt, interest after tax plus average other cost divided by average funds employed. Any doubts on this? Clear? Now, I'll tell you, if at all you have to note down something. Everything should be here. Cost of irredeemable debt, interest after tax by net proceeds. If at all something is to be written, I'll tell you here itself. Page 39. Interest after tax by net proceeds. Page 39. Interest after tax by net proceeds. What is interest after taxes? Interest into 1 minus tax rate. Why I am deducting tax? To make it after tax number. Interest is, be very careful, it's on face value, not on the issue price. Your interest is always calculated on the face value. If the problem does not give you face value, you can assume 10, 100,000 your wish. One number you assume and go ahead. You can assume it to be 10, 100,000, that hardly matters, but you will assume one number and then proceed. Next comes net proceeds. Now net proceeds can be for two scenarios. One, the issue is going to be done by the company. When I say issue is going to be done by the company, today ICICI Bank or ABC Limited says we are issuing 1 lakh debentures at the rate of. So when I make an issue today, that's called as new issue. The same issue after 4 years becomes an existing issue. So today it's called as new issue. After 4 years it will become existing issue. If it's an existing issue, net proceeds means current market price. Why current market price? The assumption is if you make an issue today, what price will you get? You will get the current market price. So for an existing issue, the net proceeds is current market price. The logic is that if I make an issue today, that is if I go ahead and say that I am going to issue debentures, what I will collect is current market price, because that is what people are paying. Current market price is basically what people want to pay for my shares or debentures. Clear? Any doubts on this? In case of new issue, for a new issue it is issue price minus flotation cost. What is flotation cost? I have already explained you. Flotation cost is basically the issue expenses. If the problem is silent, issue will happen at par. If the problem is silent, issue will happen at par. If the problem tells you something, follow it, otherwise it is at par. Clear? Any doubts on this? So face value will be 10, 100,000. Issue will always be at par if the problem is silent. Second part, using approximation method, which is redeemable debt using approximation method. Interest after tax, average other cost divided by average funds employed. I have given explanation to everything. What is average other cost is redeemable value minus net proceeds by balance life. I will explain balance life as I do a problem. Minus net proceeds by balance life. Net proceeds is already explained. Redeemable value, problem silent, redemption at par. Problem silent, redemption will happen at par. See, anything you don't know, it is at par value. That is the normal assumption. Unless you have to tell me that it is happening at a discount, premium, all of that has to be given in the question. Clear? Average funds employed is redeemable value plus net proceeds by 2. Now, another critical thing, the average other cost which you see can sometimes be negative also. How it can be negative is redemption at par, issue at premium. Redemption at par, that is 100 rupees, but I issue 110. I collect 110 and give only 100 rupees back to you. So average other cost technically can become negative also. We will see problems like that also. It can be negative also, and we are going to see some problems. Any doubts till now? This YTM method is IRR. I'll explain when it is IRR. Let's not worry about it as of now. Convertible debt also, let's now start with questions. Wherever it is critical, I'll give an explanation. Initial some 7-8 questions are not from exam point of view, it's just to understand the concept. So everything will take 2-3 minutes, that's all. That's just to understand the concept. Real problems will start beyond that. Can we start? Can we? Okay. A perpetual bond sold at par, coupon rate being 8%, compute the cost of debt. Redeemable, irredeemable. First question. Redeemable, irredeemable. Yeah, what is it? It's irredeemable. Another thing, if you are not very clear in the question, if life is not given, it has to be irredeemable only. I need a life information. So they say a bond sold at par, that also irredeemable only, because I don't know the life of the bond. Without a life, I can't do much. So it's a irredeemable debt. Now write KD equal to, I'll take you through in detail for this question. KD equal to interest after tax by net proceeds. Interest after tax by net proceeds. Come down. Interest equal to coupon rate. Coupon rate is the rate of interest into face value. Coupon rate into face value. What is the rate of interest? Face value? Nothing is given, so we are taking 100 here. 100. Any number you can take, 10, 100,000, whatever way you want to do. Let's take it as 100. Rupees 8. Then interest after tax. Interest after tax. Interest into 1 minus tax. Interest into 1 minus tax. Let's take the tax rate to be 30%. Problem is silent. We'll take it as general corporate tax rate and proceed. 8 into 1 minus 0.3. You will have to write that it is assumed. 5.6. Any doubts on this? This I will not do such detailed calculation. I could have straight away written the answer. It's just 10-second solution, but just to understand the format, we are doing it. Net proceeds. Now, any problem on debt, I ask only two questions. First is whether it's redeemable, irredeemable. Second, whether it's an existing issue or a new issue. Now, is this a new issue being made by the company or an existing issue? A perpetual bond sold at par. Now please listen. Any problem will be viewed as a new issue, except they say 2 years ago you made an issue, 5 years ago you made an issue, then alone it will be an existing issue. Otherwise, a sold at par means today I am selling at par. Today I am making it. So any problem will be viewed as a new issue, except when they give information stating that 5 years ago we did this, or the company sold bonds 2 years ago, something of that sort, then I will take it as existing issue. Otherwise, it will always be a new issue. So this is issue price minus flotation cost. Issue price minus flotation cost. Sold at what they have mentioned? Par. Par is 100. Flotation cost is not there. Net proceeds is 100. Net proceeds is 100. Now apply in the formula and get the answer. 5.6 divide by 100 into 100 to get the answer in percentage. Okay. Finally, my answer has to be in percentages. Clear? Can we proceed? Any doubts on this? Let's move to question number 2. An 8-year 12% bond with a face value of 100 sold for 92. Compute the cost of debt. Now onwards, I will not do calculation for items like interest and all. That is easy to understand. Wherever some detailed calculation is to be done, I'll take you through that alone. 8-year bond. So redeemable, irredeemable? Redeemable. So write KD equal to interest after tax plus average other cost. Interest after tax plus average other cost divided by average funds employed. Interest after tax plus average other cost divided by average funds employed. Plus average other cost divided by average funds employed. What is the interest rate they have set? 12%, face value is 100, so interest is going to be 12. 12% is the rate of interest, face value is 100, interest is going to be 12. Interest is always on face value. Now write interest after tax equal to 12 into, I am taking 30% tax rate, corporate tax rate, 12 into 1 minus 0.3. Any doubts on 8.4? Clear? Can we proceed? Next, average other cost equal to average other cost equal to average other cost equal to redeemable value minus net proceeds by balance life. Redeemable value minus net proceeds by balance life. At what rate are we going to redeem the debentures? Anything given? Nothing given. 100 face value. Nothing is given. It is 100. Now coming to net proceeds, new issue, existing issue. New issue, issue price minus flotation cost. The amount is directly given. What is that number? 92. 100 minus 92. How many years of life? 1. 100 minus 92 divided by 8. Now listen, why balance life is, if it's an existing issue, what you will subtract is current market price. What you are going to subtract is current market price. There's a concept of finance which states that any values asset is the present value of whatever money which is going to come from that asset class. So the current market price will basically reflect how many year more cash flows are going to come, and indirectly it says that if the life is only 2 years or 3 years, the value of that instrument will become closer to your redeemable value. Any asset class value will become closer to the redemption value as we reach near to its redemption. So on the date of redemption, the market price as well as redeemable value will be same. So what the concept says is, today it is 92. Redemption is going to happen at 100. In 1 year it will become 93, then it will become 94, then it will become 95, then it will become 96, 97, 98, 99, and on the last day it will touch 100 rupees. The asset will touch 100 rupees. So what they are saying is, if you are doing only 6 more years, then the calculation will automatically become 100 minus 94. Why 94? Because that will be the market price. That is why denominator has to be balanced life rather than the overall life. It has to be balanced life. This is applicable only in case you are using the current market price. If you are using the issue price, it means the whole life is still pending, because the issue price is basically today's price. When it's today's price, it means the whole life is still pending. So 100 minus 92 by 8 is 1. Any doubts on this? Next, average funds employed. 100. Okay, you first write the formula once. What is the formula? Redemption value plus net proceeds by 2. Average. Redemption value plus net proceeds by 2. What do we get? 96. Now we are going to use this in the formula and get the cost of debt. Any doubts on this? How much was the interest? 8 point. Please don't copy it from the board. I keep seeing people referring to the board. I don't know what is there. Any doubts on this? Can I proceed? Anybody has any doubts on this? Let's go to question number 3. A 7-year 100 debenture is available at 92, coupon rate 15%, redemption at a premium, tax rate is 40%, compute after tax cost of debt. Okay, first question, redeemable, irredeemable? Redeemable. Let's write the formula. KD equal to interest after tax plus average other cost divided by average funds employed. Interest after tax plus average other cost divided by average funds employed. Divided by average funds employed. Now IAT equal to interest after tax. What is the interest rate given in the question? 15. Face value? 100. Face value is 100. So 15 into 1 minus 40%, 1 minus 0.4. 15 into 1 minus 40%. 15 into 1 minus 40%. Your interest after tax is rupees 9. 15 into 1 minus 40%. Any doubts? Average other cost is, what is the formula? Redemption value minus net proceeds by balance life. Redemption value minus net proceeds by balance life. What value are we going to redeem? 106. Net proceeds 92. Life. It's a very simple calculation. You just need to go through the numbers and put it in the formula. That's all. I don't have much to explain here. Cost of debt is the easiest of the lot. Average funds employed, redemption value plus net proceeds by 2. Nine plus 2 by 99 into 100. Please don't copy it from the board. You do it. I am not explaining something complex here. You just need to do it and refer to the board just to check the answer. 9 plus 2 by 99 into 100. Can you proceed? Clear? Next one. A 10-year 10% 1000 par bond sold at 950 less commission. Compute cost of debt. Again the same thing. Redeemable, irredeemable formula arriving. There will be one adjustment, that alone I want to explain. Let's start. Cost of debt equal to, what's the formula? Interest after tax plus average other cost divided by average funds employed, IAT equal to interest into 1 minus tax. It's not necessary, the main formula alone is critical, other things even if you don't show it, it's fine. What is the interest? 10% on 1000, 100 into 1 minus 0.3, 70. Wherever tax is not there, you write either you ignore the tax or consider 30%, but you will have to write that line. Don't go ahead and just do 30%. Everywhere I have done this 30%, you'll have to write, it is assumed tax is 30%. You'll have to keep writing that line. It is assumed tax is 30%. Next, average other cost, redemption value minus net proceeds, redemption value minus net proceeds by balance life. What will be the redemption value? 1000. Net proceeds 90. Any other answer? That 5% underwriting commission which you see, no, it can be taken as a percentage of face value or as a percentage of your flotation cost. Basically, the flotation cost can be 5% of 1000. It can also be 5% of 950. Consistency is not there in solutions given by institute. So we will write whatever you want to consider. You consider 5% of 1000, write a note. 5% of 950, write a note. We'll take it as 5% of 950 and proceed. But you will have to write a note on that. So I'll give that note in some time. Now, minus 950 minus 5%. 950 minus 5%. It can be 950 minus 50 rupees also. 5% of 1000. It can be 5% of 1000. How many years life? 10. This is how much? 9.75. Done. Then average funds employed. How much? 8.38. And then write a note. It is assumed that underwriting commission is 5% of issue price. Your wish, you want to take it on face value, take it, but write a note. Underwriting commission is 5% of underwriting commission is 5% of issue price. That's the assumption with which we have done it. Want to take an alternate assumption, take it, but whatever you take, please write it down. Underwriting commission is 5% of issue price. Clear? Any doubts on this? Can we proceed? Go through question 5 and do it. Go through it and do it. I'll help you out if at all you get stuck somewhere. Redeemable, irredeemable? Redeemable. Interest after tax plus average other cost divided by average funds employed. I'll straight away write here. Interest after tax is 10. Tax rate given? Not given. Let's take it 30%. 10 into 1 minus 0.3 plus average other cost is redemption value. What is the redemption value? 105. Net proceeds is, this is an existing issue, and for an existing issue net proceeds is current market price. For an existing issue it is current market price. So 105 minus 85 divided by balance life of 5. How much? It will be more, I thought. It will be more. You said 7 or 11? 11. Okay, sorry. 11 point. In this case, it's current market price because this is an existing issue. Normally, it's always new issue unless they say 2 years ago, 5 years ago. Otherwise, it's always a new issue only. Issue price minus flotation cost. In this problem, you cannot take that. You cannot take it as issue price of 100 minus flotation cost of 10%. That is not going to work out. It has to be current market price of 85. Any doubts? Can you proceed? Question number 7. Any doubts on question number 6? Anybody has any doubts? Sorry. Question number 6. Let's do question number 6 now. Try doing it. If at all you get stuck, let me know. The flotation cost, you'll have to make an assumption, is it percentage of face value or issue price? Because the issue price is going to be 950, discount of 5%. So the issue price will be 950. The flotation cost can be taken as 3% of 1000, 3% of 950. So 1000 minus 950 minus 3% divide by 10 years. It's given in the question. Oh, sorry. Any doubts on 5.61%? Can we proceed? Okay, question number 7. Do question number 7. I'll take you through 8 onwards. Do 7. Please do 7. I'll take you through 8 onwards. So, only 2 questions: redeemable, irredeemable, new issue, existing issue. You keep asking that and keep solving as per that. Any doubts on this? Can we proceed? Any doubts on 9.23%? Can we? Okay. Okay. Now I'll take you through question 8. Any doubts till now? Now let's go through this. A company issues 10 lakh 12% debentures of 100 each. Debentures are redeemable after 7 years. 35% tax. Cost of debt after tax, that is KD. If debentures are issued at par, 10% discount and 10% premium. 3 scenario. Fourth scenario is brokerage is paid at 10%. What will be the cost of debentures? Now how many debentures have been issued by the company? 10 lakh. When I solve a problem, I'm least bothered whether they issue 10 lakh debentures or 10,000 debentures. For us, it's only one debenture. All our cost of debt calculation will happen with only one debenture. The same formula, interest after tax plus average other cost divided by average funds employed. We'll get 4 different answers because there are 4 different scenarios to the question. Let's start. Cost of debt, KD equal to interest after tax plus average other cost divided by average funds employed. Interest after tax plus average other cost divided by average funds employed. In that scenario 1, issue at par. Issue at par. What's the rate of interest? 12 into 1 minus 0.35 plus 12 into 1 minus 0.35 plus what will be the redeemable value of the debenture? Anything given? No, so 100. Issue price minus flotation cost. Please participate. Net proceeds is issue price minus flotation cost. In case you want me to write it detail, I'll write it. If at all you are getting stuck. Redeemable value. What is the formula for average other cost? Redeemable value minus net proceeds by balance life. Redeemable value is 100. Net proceeds is issue price minus flotation cost. What is the issue price? 100. Any flotation cost? That is only for the part 4 scenario. So as of now it is 0 only. 100 minus 100 divided by 7. Twelve into 1 minus 0.3 plus 100 minus 100 by 7 divided by 100 plus 100 by 2. Second scenario is what? Issue at discount. Issue at discount. Twelve into 1 minus 0.35 plus redeemable value is 100. Redeemable value is 100. Net proceeds, it's 90. Clear? Any doubts on this? If at all you need an explanation, please let me know. It's 100 minus 90 divided by 7 100 plus 90 by 2. Any doubts in this? Scenario 3. Issue at premium. Everything will remain same. It will become 100 minus some other number. That's all. That is the only change we have been doing. 100 minus the net proceeds will keep changing for the 4 scenarios. Everything else remains same. Obviously, average funds employed will change accordingly. In this case, average other cost is negative. It can be negative. Your average other cost can be negative, and we see this scenario where issue has happened at premium, redemption is going to happen at par. Problem silent, redemption will always be at par only. Last scenario, 2% flotation cost. How much? 8 point. Clear? Can we proceed? Any doubts on 8.17%? Clear? Next, let's move to question 9. Anybody still working out on question 8? Can we proceed? Okay. A company issued 10,000 15% convertible debentures of 100 with a maturity period of 5 years. At maturity, we'll have the option. They will have the option to convert the debentures into equity shares in the ratio of 1:10. So I'm going to issue some convertible debentures where I have an option of converting them, but the ratio is 1 debenture will give me 10 shares. It's an option available at my hand. The current market price of the equity share is 12, and historically the growth rate of the shares are 5% per annum. Compute the cost of debentures assuming 35% tax rate. Just make a small change in this equation. This 12 will make it as 8, the current market price. Make it as 8. Now, in a convertible debenture, I have an option whether to convert or not. It's my choice. So redeemable value is basically everything remains same. Redeemable value will change. Redeemable value is equal to higher of bond value or stock value. Higher of bond value or stock value. Now what is higher of bond value or stock value is, on the date of redemption, bond will give you 100 rupees. On the date of redemption, bond is going to give you 100 rupees. How 100 rupees? That's the redeemable value. Till now you have learnt. If you don't get that, or I have a choice, whichever I can choose, it's in my hand. So one bond can be converted into 10 shares. On the maturity date, I don't know what price it will be. It can be any price. If it is something like 12 rupees, 14 rupees, then I get 140 rupees, I'll convert into shares. If it's like 8 or 9, I will not convert and get back the 100 rupees. That's perfectly my choice. So the expected stock price, I have to calculate something called as expected stock price, which is nothing but what is the current market price of the share? 8, and historically the growth rate is 5%. So now please listen. 8 into 1.05 the whole power 5. 8 into 1.05 the whole power 5. That is 8 will increase by 5%. In calculator, it's basically this 8 plus 5% plus 5% plus 5% plus 5. You do it 5 years. That is nothing but 1.05 the power 5. So after 5 years, this is the expectation. Whether this happens or doesn't happen, I'm not bothered, because today I'm doing the calculation. When I today do the calculation, this is my expectation. 8 into 1.05 the whole power 5. Can you tell me what is this value? 10.21. Now please listen. Expected stock value. I'll tell you when to note it down. 10.21 into 10 shares. Every bond will give you 10 shares. So you will get a value of 102.10. Now it's your wish whether you want to take 102.10 or 100. Because on redemption you will get 100 or 102.10, whichever is higher, because it's my choice. So that is the only change. Redeemable value alone will change. Redeemable value in this question will become 102.10. It will become 102. For a convertible bond, formula is redeemable value, interest after tax plus average other cost divided by average funds employed. Same way calculate interest after tax, same way calculate net proceeds. Redeemable value alone, we'll have to do it little bit calculation. Now write KD equal to interest after tax plus average other cost, interest after tax plus average other cost divided by average funds employed, divided by average funds employed. Interest after tax equal to what into what? 15 into tax rate given? Yeah, given. 15 into 1 minus 9 point. Now I cannot straight away go and do average other cost, so I'll have to do a calculation for redeemable value. Next, redemption value. Center of the page, redemption value. Split it into two. Bond shares. You can redeem it as bond itself, or you can redeem in the form of shares. If you redeem the bond, you will get rupees 100. If you redeem it as shares, 10 into 8 into 1.05, this 1.05 the whole power 5, 10 into 8 into 1.05 the whole power 5. This will give you one value. Your choice, what you want to take it. How much is this value? 102.10. 102.10. It's my choice what to take up. So I'll decide whether to go with 100 or 102.10. We will go with what? 102.10. So this is redeemable value. You can put this in a box. Redeemable value is 102.10. Beyond this, the problem is the same thing. I don't have much to explain beyond this stage. 102.10. Beyond this, you will do the normal way of calculation. Redeemable value minus net proceeds by balance life. Redeemable value plus net proceeds by 2. All of that is going to remain same. My role ends with that 102.10. What are the net proceeds? 100. How many years?
5 years.
10 point. Done. If this was not convertible, you would have done 9.75 plus 100 minus 100 by 5. That's all. For a non-convertible, you would have done 100 minus 100. For convertible, you have to do this check and it's higher of the two. If equity was only 80, I would have again written 100 only. If equity was 80, we would have written 100 because it's an option to convert, not mandatory to convert. Any doubts on this? Can we proceed? Let's do question number 10. Any doubts on question number 9? 5 years ago, Soma Limited issued 12% irredeemable debentures at 103. The current market price is 94. Tax rate is 35%. What is the current cost of debenture capital? You do it. Cost of debt. What will be the answer? 8.9%. What is the denominator you are taking? 94. It's going to be 12 into 1 minus tax rate divided by 94. 12 into 1 minus tax rate divided by 94. So 7.8 by 94 is the answer. 7.8 by 94. Okay. I'll proceed to question 11 now. Now please listen. Listen for some time. They have given debentures value. X Limited Series 1 debenture of the face value 100 bear a 10% coupon rate. Such debentures currently yield 12%. What does this currently yield means? What is the rate people are expecting? So everybody in the market is expecting 12%. Current yield means what is people's expectation. So people are expecting in the market 12%. What is the rate of interest the company is paying? 10%. Now the rule is, if you are not meeting my expectation, you have to give me at a discount. You are giving me only 10%, whereas everybody is expecting 12%. If you are not meeting my expectation, give me at a discount. If you are meeting my expectation, give me at par value. If you are exceeding my expectation, give me at a premium. I am ready to pay a premium if you exceed my expectation. I'll pay the par value if you meet my expectation, and I want a discount if you are not meeting my expectation. That's the rule. Clear? Any doubts on this? Now write. Present value of perpetuity equal to perpetuity amount divided by investor expectation. Perpetuity amount divided by investor expectation. Investor expectation is nothing but the interest rate, as such we call. Perpetuity amount by investor expectation. Now listen, coming to present value of perpetuity, I am going to substitute present value of perpetuity with current market price. That's what they want us to calculate. Current market price. Perpetuity amount in case of a bond is interest. Investor expectation is the current yield which is given in the question. Listen for some time. Now, what is the bond paying? 10% on a face value of? So bond is paying 10 rupees of interest. People are expecting what rate? 10 divided by 12% is how much? 83 point. I'm saying I'm not going to pay you 100 rupees because you are not meeting my expectation. When you don't meet my expectation, you are not authorized to collect the entire money. You have to give me at a discount. Wait for some time. I'll tell you to note it down. Scenario 2, what they mentioned. If increases the coupon rate to 12, see this was market price till now. Now these various scenarios. Increases the coupon rate to 12, drops it to 6. 12% means, am I meeting the expectation or exceeding? Meeting the expectation. It will be par value. Current market price is equal to 12 by 12%. If you meet 100 rupees, if you are meeting it as, let's assume he wants to give 14%. 14% means 14 rupees. 14 by 12%. And what is the scenario given in the question is? So if it drops to 6, I'll pay only 50 rupees. If it is 10 rupees, if it is 10%, I'll pay 83. If it's 12%, you meet my expectation, get 100 rupees. If you got a 14%, you are exceeding my expectation, I'll pay you 116. You give me 18%, I'll pay more. 20%. So as long as you exceed my expectation, I am ready to pay a premium. If you are not meeting my expectation, give me at a discount. This is for irredeemable debt. Redeemable debt, what has to be done, I'll explain in some time. Now complete this. Current market price 10 by 12%. This is not there in the question. 10 by 12% is the original scenario, and then the multiple scenarios. $8,350. Can you proceed? Now coming to the second part, what would be the market price if the debentures were originally having a 15-year maturity period and the maturity period is 4 years away from now? That is only 4 more years is pending, which is a redeemable debenture. Now please listen. Any asset you want to value, you need these 4 things: year, cash flow, PVF, DCF. For example, somebody says he wants to value this building. You can end up valuing the building like this. Year 1, you will earn rent of 4 lakhs. Year 2, you will earn rent of 4.5 lakhs. Year 3, you will earn rent of 5 lakhs. Whatever number you want to decide on. You do your calculation and keep writing it. Year 4, 5.5 lakhs. Year 5, 6 lakhs. Year 6, 6.5 lakhs. At the end of year 6, I'm going to sell it for 100 lakhs. That's my calculation. This is what I have thought about. This is what the building's value will be. This is my calculation. But I need this number. You will have to tell what is the year and cash flow you expect from any asset. You want to value a mobile phone, you can value this. You want to value a car, you can value this. The basic thing is you have to tell me year and cash flow. So when I buy a mobile phone or a car, it is not for a commercial purpose. But a car could be a commercial purpose for someone who is in the business of hiring vehicles. So in that case, he will be again doing this analysis and decide whether to buy this car or not, or at what price do I buy it. So I have written the cash flow. Then I'll ask you what is the rate you want to earn. Somebody will say 10%, then you do PVF for 10%. Somebody will say 12%, then for him we'll do 12%. Somebody can say 14%. Different people can have different expectation from an asset class. So 10, 12, 14 equal to 1 divided by 1.1, NPV calculation, divide by 1.1, goes on like this, and I am done with my valuation of building. According to the person who wants a return of 10%, he should pay 78 lakhs for this building today. That's the valuation. The valuation says you should pay 78 lakhs for this today if at all you want a 10% return. Somebody says he wants a 12% return, then he'll pay a further lower amount, 1 divided by 1.12. If you want a 12% return, you will pay only 71 lakhs. So different people will have different expectation. Somebody will say it's not 4, 4.5, I think it will be 6, 6.5. So that is where a purchase and a sale happen. Different people have different expectation from an asset class. So if this building is available at 75 lakhs, then this person who is thinking it to be 78 would like to buy it, because he thinks the fair value of this building is 78 lakhs and somebody is ready to give at 75, I'll be okay to buy it. Person who thinks a 12% return would like to sell such property because he thinks the right value is only 71. Somebody says 71, somebody says 78. If it is 75 lakhs in between, if the price is that way, one person would like to buy that building, another person would like to sell that building. Obviously, see, any transaction which happens, people have to have opposite expectation. If I feel the building price is going to increase, I will buy it. You will feel building price will go down and then only you will sell it, unless there are liquidity problems or other issues. Normally when somebody sells an asset, you believe that the value will come down. I believe that value will go up. That is why I buy. So anybody who wants to value an asset, any asset class, I'm making it very clear, any asset you want to value, just assume somebody wants to buy a building and you want to do this analysis. You just need these numbers. You need to sit, talk to the person, can you tell me how much rent are we expected to receive? Do you think we'll sell it after 10 years, 15 years, 20 years, 25 years? At what price are we expecting to sell this property? Some number has to be there. Whatever is your gut feeling or whatever number, scientific calculation or whatever be the way, get the year-end cash flow. PVF is always depend on the person. Somebody will be happy with 10% return, somebody will be happy with 15% return, somebody will be happy with 20% return. That's obviously what a person wants. So you get this structure, you will be in a position to value any asset. We normally use it for financial assets, but if I want to value a building, a car, anything, be it any asset which generates revenues or reduce cost, any asset class which can generate revenue or reduce cost. A television may not be generating revenues for us, but it could be a revenue generation item for someone else. So any asset class, a car is a perfect example. So somebody who is into the business of hiring it out, for him it is an asset which generates revenues. For us, it's not an asset which is going to generate revenue. We are buying it for the comfort point of view. So any asset class which generates a revenue can be valued using this method. Asset classes which cannot generate revenue, it is always what a person wants, because somebody would be extremely interested in a car, he would be okay paying 10 lakhs, 15 lakhs, 20 lakhs. It is all about your emotional factor. So there, nothing of finance is going to work out. So any asset class which you buy apart from finance purpose or apart from a cash flow earning purpose, any asset which I buy a television because I feel there's a good amount of comfort in it. Now, can I value it in terms of money? No, I cannot value the benefit which I get out of a car in terms of money. It's the comfort. Nobody can value the comfort part. So any asset which you buy, there will be certain comforts which are derived from it. Those cannot be valued. What can be valued is something which can be translated into revenues. Now, coming to this problem, how many more years the asset is going to be there? 1, 2, 3, 4. What is the rate of interest the asset is paying? First year 10, second year 10, third year 10, fourth year 110. Fourth year 110. 110 is because including principal. After the fourth year, you will get back your principal. What is the rate people are expecting today? Not 10. 12. People are not expecting 10, no? That's the original scenario, no? If the debentures were originally having a 15 year, would you pay rupees 90, rework the market price if the investor expects a return? That is rework in that itself. That is a rework in that itself. Now, as of now, I am analyzing from the original point of view. So, from the original point of view, people wanted 12% return. Now, again, I am telling you, what rate the company is giving? 10. What rate people are expecting? It has to be a discount. It will be a discount. You can do it as 1 divided by 1.1 to write the number equal to, put a total of the DCF, that is the fair market price of the debenture. Clear? Any doubts on this? Next, valuation of redeemable debt. Valuation of redeemable debt. Value of a redeemable debt value of a redeemable debt is the present value of future cash flows, discounted at investors required rate of return. Now I've given this value of redeemable debt. You can change it as anything. Value of a building is the present value of future cash flow discounted at investors required rate of return. Value of a company is the present value of future cash flows discounted at investors required rate of return. Anything. You tell me what rate you expect and what cash flow are we going to get. Clear? Any doubts on this? Now PVF at 12%. Create this structure. Year cash flow, PVF at 12% and DCF. $93.98 is the fair value. Fair value means the expected value. In reality, the value can be higher or lower, but according to our analysis, it should be at 93.98. According to the analysis, the worth of this asset is 93.98. Any doubts on 93.98? What is the real value they are saying? Would you pay some amount they have mentioned? Would you pay 90 rupees? It's 93.98, but they are saying, would you pay 90 rupees for this debenture? Yes, because it's an undervalued asset. You went to the shop thinking something will be available at 94. The person says it's only 90 rupees. You are very happy because you are getting a lower value. You are able to pay it with a lower amount. So you felt it has to be 94. You go with that expectation. But suddenly someone says 90 rupees, you go ahead and buy it, that's all. You don't even think about it. Because 94 is the real worth. If it was 96, I will not buy it. Now, right? The fair market price is rupees 93.98. Is rupees 93.98. 93.98. Whereas the current market price is rupees 90. Is rupees 90, full stop. The debenture is undervalued. And hence we should buy the debenture. Debenture is undervalued and hence we should buy the debenture. Any doubts in this? In that they have given a rework with what rate? 10%. Investors' expectation is 10%. Listen for a minute. Can you tell me what will be the value without doing any calculation? it has to be 100 because he expects 10%, company gives 10% weight. Unless there is a redemption happening at premium. If it's happening at par, okay. If it's happening at premium, then it may not be 100, you will get a different number. See, everything is at par, interest paid 10%, interest expected 10%, I'll get a 100 answer. But if redemption is at some 105, 110, then you will not get 100, you will get a different answer. So let's do this now. We'll show this again at 10% expectation. You will get answer as 100, that I'm sure. But let's anyway show it. PVF at 10%. Any doubts on this? Clear? Can you proceed? Coming to question 12. Okay, now listen for some time. RBI proposes to sell a 5-year bond of 5,000 at 8%. The bond will be amortized equally over its life. What's the bond's present value? That is today's price. If investor expects how much? 6%. What is the RBI rate giving? 8%. What will be the final value of the bond? More than 5,000, less than 5,000? What is the expected answer? More than 5,000, less than 5,000? More than 5,000, because RBI is giving 8%. People are expecting only 6%. Clear? Any doubts on this? Now, amortized equally means every year I'll pay back 1,000 rupees principal. Every year I'll pay back 1,000 rupees principal. Now, why this is critical is, first year you will charge interest on 5,000. Second year only on 4,000. Third year on 3,000. Fourth year on 2,000. Fifth year on 1,000. So, the interest will be on 5, 4, 3, 2, 1. That is how you'll have to calculate. Let's put it in that structure. Calculation of present value of the bond. Year cash flow PVF at 6%, DCF. Calculation of present value of bond. Year cash flow PVF at 6% and DCF. Cash flow PVF at 6% and DCF. How many years is the cash flow? First year is 5,000 into 8%, 400 plus 1,000 rupees of principal. You will earn interest of 400 and get back 1,000 of principal. 400 plus principal 1,000. 5,000 every year 1,000 rupees amortized over its life. Equally amortized over its life. So every year you will get back 1,000. Any doubts on 400 plus 1,000? Next year what it will be? 320 plus 1,000. It has to be more than 5,000 because people are expecting only 6%. If people expect 8%, will exactly get 5,000. What the bond pays vis-a-vis what people are expecting. Done? Can we proceed? Any doubts in this? Anybody has any doubts in this? Clear? Now, we are done with debentures. I'll move now to equity shares. Now, how is cost of equity share capital? There are multiple formulae. I'll explain whatever is the critical formula and then we straight away go to the problem. Now, there will be broad scenarios. You may note it down later on. I'll tell you this will be the broad scenarios. So there are multiple things mentioned there. Cost of equity, two broad scenario, company paying dividend, company not paying dividend. You will learn in dividends chapter when to pay dividend, when not to pay dividend. So there can be two scenarios. There are set of companies who will pay dividend. There are set of companies who are not going to pay dividend. If you don't pay dividend, there's a formula. Cost of equity is equal to RF. RF is risk-free rate of return plus beta into RM minus RF. This is the formula. I'll explain the logic now. RF plus beta into RM minus RF. Beta basically indicates how risky a security is. So whether if more higher the beta, more risky it is. Lower the beta, less risky it is. Beta can be negative also. It can be negative. You will learn in detail about beta and all at final level, but beta basically measures how risky a security is. Now, when I calculate this KE, now we were doing this analysis earlier saying that what rate of return somebody wants. This KE can be for anything. I can calculate what return I need from a building, what return I need from a equity share, what return I need from an FD. For everything you will have to tell me a beta value. Beta basically means how risky we feel. Somebody will say buildings beta should be 2 times because I feel it is more risky. Equity share should be 1 time. Debenture should be 0.5 time. Fixed deposit should be 0.2 time. Loan to an unknown person should be 1.5 times. So some risk you will have to attach to any security. Now what it says, now let's take an example, government security. RF is 6%. What is RF is? Risk-free rate. Risk-free rate is indirectly only for the government security. For government security, the beta is 0. So 6.5 plus 0 into RM means the return which the market can give. Market is the average of all the assets which are there. In short, it is the return given by Nifty or Sensex in India. Nifty and Sensex are considered to be the representative of the market. So market can give you 12% return. So if any security has a beta of 0, the answer will be 6% through the formula. 6 plus 0 into 12 minus 6. Somebody says I have a security whose beta is 0.25. I consider it to be a little risky. Fixed deposit. FD with State Bank of India has a risk of 0.25. Then you will do 6% plus 0.25 into 12 minus 6. This will tell you how much return you should need from an FD. So I was saying for a building year cash flow, you will calculate PVF what to take. You tell me how risky you feel the building to be. 0.25, 0.5, 0.75, 1, 1.25, 1.5, any number you want to take. Take the number, put it in the format, you will get to the answer. So for a 0.25 beta, the return has to be how much? 7.5. Then you go to another security which you feel the beta is 1 time. which is exactly like market. Market also has a beta of 1. We will also have a beta of 1. Market is expected to have a beta of 1. So then 6 plus 1 into 12 minus 6, answer will be 12. If you feel some security is 1.5 more risky, very high risk, you need a high return. High risk, high return, low risk, low return. That's the concept. So 6 plus 1.5 into 12 minus 6, you will get 15%. So this, in that 4 items which I was saving here, cash flow, PVF, DCF, this PVF at the rate can be determined through this. Investing in a building, I feel it has a risk of 2 times. Investing in a new factory, risk of 2.5 times. So anything which you do, there is a risk attached to it. Whether you understand beta or not, you understand risk. People do understand risk. They feel that giving a loan to an unknown person is riskier than giving a loan to a known person. So it's all known to you guys. So you know what is risky, what is not risky. If I give you 2 options, you will tell me which is more risky, which is less risky. But if I tell you which has more beta, less beta, you will not know it because we have not understood it as beta. Beta means high risk, high beta, low risk, low beta. Clear? Any doubts on this? So this is one way if you are not paying dividend. If you are paying dividend, 3 scenarios. No growth, constant growth, step up growth. No growth, constant growth and step up growth. No growth means every year same dividend. Every year same dividend. Every year if you receive the same dividend, it's called as perpetuity. Every year if you receive the same amount, it's called as perpetuity. What is the cost of irredeemable debt? Cost of irredeemable debt. Tell me the formula. I call it as equity dividend. Then denominator. Net proceeds was issue price minus flotation cost. So P naught minus flotation cost. P naught is current market price or issue price minus flotation cost. So the cost of equity of a non-growing company is interest after tax by net proceeds only, but I don't call it as interest after tax. I call it as equity dividend divided by net proceeds only. What is net proceeds? Issue price minus flotation cost or current market price. So I have written in denominator P naught minus F. P naught refers to current market price or issue price. F refers to flotation cost. So if at all flotation cost is there, you deduct it. Clear? Any doubts till now? If it's constantly growing, then it's a growing perpetuity. If it's a constantly growing, it's a growing perpetuity. What is the formula for growing perpetuity? Present value of perpetuity equal to perpetuity amount minus growth rate. Interest minus growth rate. This is what the formula I have done in time value of money chapter. Interest minus growth rate. I swap the formula now. Interest I call it as cost of equity minus growth, perpetuity amount divided by present value of perpetuity. Net it becomes K is equal to D1. D1 means dividend of the next year. P naught minus F plus growth rate. You'll have to add the growth rate to it. Now to again explain, this formula is also plus growth rate only, but there the growth is 0. That's why it is not coming separately there. It's not that I've given you a new formula. Plus growth rate exists in the first formula also, but plus growth rate will become plus 0% because it's not growing. So you will put plus 0%. So I'm saying not to put plus 0%. So I've removed that. So this formula is K is equal to dividend P naught minus F plus growth rate. I'll explain this with the problem. These steps I'll explain with the problem. Anyway, it's there in the theory. You just write this breakup alone. This is not properly come in the theory. Write the breakup alone. 4 scenarios. There are other scenarios given in the theory. I'll explain all of that with the problem. The predominant 4 scenarios are this. two basic split: paying dividend, not paying dividend. Not paying dividend, it is technically called as CAPM, capital asset pricing model. CAPM, not paying dividend, capital asset pricing model. Okay. Now, if you see here, broadly the same thing would have been covered. Dividend price approach with no growth in dividend. Dividend by current market price minus flotation cost. D1 by P0 minus F plus growth rate. D1 by P0 minus F plus growth rate. Earnings by price approaches. Whatever above two formula you have seen, in place of dividend, use earnings. Earnings is what overall amount the company earns, whether they pay it or not. So the formula will become this itself. Earnings by current market price minus flotation cost. Earnings by P0 minus F plus growth rate. More or less broadly the same formula. E1 by P0 minus F plus growth rate. E1 by current market price minus flotation cost. It has to be minus flotation cost. Realized yield approach is what I was explaining, saying that step up growth. I'll be explaining that later on. I think that will get covered when I do dividends chapter. There the step up growth should get covered. And finally CAPM approach, which is RF plus beta into RM minus RF. In this, the important thing is how are we going to calculate growth rate. Some problem may not give it. I'll explain that with the question itself. So now let's proceed to the questions. Question number 13. Okay, let's do. The dividend per share of a firm is expected to be 8 next year and is to grow at 5%. Current market price 80, cost of equity. What will be the growth rate? What will be the position if the growth rate was 0%? Now, first question, is the company paying dividend, not paying dividend? Paying dividend. If it pays dividend, original scenario, no growth, constant growth, step up growth. Step up means they'll say 10% for a few years, 15% for a few years, 20%, like that they'll mention. So is it no growth, constant growth? Constant growth. So let's write KE equal to D1 d1 by p naught minus f plus growth rate. Ke equal to d1 by p naught minus f plus growth rate. d1 by p naught minus f plus growth rate. Okay, now please listen. One critical thing is it is D1. D1 means dividend of next year. If they give you current year dividend, then you'll have to add some growth onto it and make it next year. What is given in the question? 8 is current year, next year. Next year. So let me write 8 divided by what is the current market price? Any flotation cost information? Your flotation cost will not be for current market price, it will always be only for issue price. 8 by 80, growth rate is how much? Now listen for a minute. Right, 8 by 80 plus 5%, right, 8 by 80 plus 5%. Okay, now when you do the calculation, 8 by 80 you do and convert into percentage. So 8 by 80 is 0.10, which is nothing but 10%. So listen for some time. Either you do the problem as 0.05. If you're getting confused, you will do it as 0.05. Then 0.10 plus 0.05 is 0.15 or 15%. 0.15 or 15%. Or you leave it as 5%. Then 8 by 80 is 10% plus 5% is equal to 15. 10 plus 5 is equal to 15. 10 plus 5 is equal to 15. This is for the original scenario. In the rework, what they've said? Growth rate is 0%, right? K is equal to, that's all, D1 by P naught minus F. D1 by P naught minus F. D1 by P naught minus F. D1 is how much? %, and 10%. Any doubts in this? Clear? Can you proceed? Any doubts in this? Next, question number 14. A company is rapidly losing money and its future rate of growth in dividend is negative 10%. Dividend today is 10, current market price is 50. Calculate the cost of equity. Company paying dividend, not paying dividend? How do you say not paying dividend? It is paying, not 10 rupees. Which one? That's okay, but they are paying dividend. They are paying dividend. The basic thing is the dividend being paid? Yes. Let it be negative growth or positive growth, that's a different story. We'll come to that in some time. They are paying dividend. Now, is it no growth, constant growth? It's constant negative growth. It can be positive, negative. I have not said that constant growth has to be positive. The formula will remain the same. Just that when you do plus growth rate, you'll write minus 10. It's not plus 10 because it's negative growth. The growth need not be positive. It can be negative also. So now write K is equal to D1 by P naught minus F plus growth rate. D1 by P naught minus F plus growth rate. The 10 rupees is D0 or D1? D0. Dividend today, D0. Now 10 minus 10%. Normally I'll add growth. In this question it's a negative growth. 10 minus 10% divided by current market prices 50 minus negative growth. So I have done minus. The growth can be positive, can be negative. In this question, it is negative growth. So 18 minus 10 percentage, 8 percentage. Any doubts? Go through question 15. Please go through question 15. Okay, now coming to this question, is the company paying dividend, not paying dividend? They have been paying dividend for the last 6 years. They have given the dividend as these numbers. Now if I look at these numbers, some years it has grown, some years it has degrown, it has not been consistent and all. So now what they say is that if you give a history and the expectation is that if the historical numbers are given, with that I'll get a one growth rate, and that growth rate will always continue to be there. So whatever has happened in the past, get a single growth rate for the past, and assume that that will always grow at that specific rate. It's going to be a constant growth. It's going to be a constant growth in future, not in past. When it step up, the question will say 10% for few years, 15% for few years, 5%. So that has to be mentioned. So this problem will fall under constant growth. The important thing is how to calculate the growth rate. Working note 1, calculation of growth rate. Calculation of growth rate. Point number 1, dividends for the last 6 years is given. Dividend for the last 6 years is given. 6 years is given. 6 years is given, full stop. Dividend of rupees 10. Dividend of rupees 10. Dividend of rupees 10 has become rupees 12. Dividend of rupees 10 has become rupees 12 in 5 years. It's not in 6 years. Though they have given the 6-year data, technically this will be like year 1, 2, 3, 4, 5, 6. So from year 1 till year 6, in 5 years, dividend of 10 has become 12. Dividend of rupees 10 has become dividend of rupees 12 in 5 years. Now please listen. Present value equal to 10. Future value equal to 12. N equal to 5. R equal to question mark. This R is basically the rate. I'll have to get it from the time value of money tables. For the class purpose, I'll tell you what R is going to come out to be. But present value is 10. Future value is 12. N is 5 years. R is question mark. It will become 12 is equal to 10 into 1 plus R the whole power 5. In that R, whatever you get is the answer. So for class purpose, I'll tell you what is R. You can just note down this. Present value equal to 10. Future value equal to 12. N equal to 5. R equal to 3.71% approximated to 4%. R equal to 3.71% approx 4%. You will not be in a position to do it in the calculator. You will have to take the time value of money tables and see that and do it. So R is 3.71% approximated to 4% growth. Now it's a problem where there is going to be a constant growth of 4%. A problem where there is going to be a constant growth of 4%. Let's write the formula. K is equal to D1 by P0 minus F plus growth rate. D1 by P0 minus F plus growth rate. D1 by P naught minus F plus growth rate. What will be the dividend? It is 12 which was paid. I'll have to add a growth rate of 4%. So 12.48 divided by 100 minus 2. The assumption is if at all I make a new issue, I'll have to incur this flotation cost plus now whatever I have done for growth rate, that's called as point to point model. You take one level, go to the last level and compare them and get the growth rate. Technically called as point to point model. Next problem, you will have another formula to calculate the growth rate. Any doubts on 16.73? Clear? Can we proceed? Any doubts on 16.73? Let's do question number 16. Z Limited share is currently selling at 60, EPS is rupees 6, payout ratio is 100%. What is cost of equity? Payout is 14%. It earns 15% on its investment opportunity. What would be the firm's cost of equity? Now listen, there are two parts to the question. One, payout of 100%. Second, payout of 40%. Now, I create a fixed deposit in a bank. When I create a FD in a bank, now let's take this example. I create a FD in the bank and I earn 1 lakh. Sorry, I create a FD of 1 lakh in the bank and bank gives me an interest of 10%. I earn interest of 10,000. So principal, interest. So principal was 1 lakh, interest was 10,000. Now I can decide whether to pay out this money or retain this money in the bank. When I say payout, I'll take out the 10,000 rupees. When I say retain, next year FD will be 1,10,000. Next year FD is going to be 1,10,000. So as a concept of finance, what they are saying is, whatever you are earning, if you pay out the entire amount, the growth is going to be 0. Why growth will be 0? Next year again principal is 1 lakh, interest is 10,000. You take out the money, next year again 1 lakh, interest is 10,000, because that can't increase, because you are taking out the money which is there. Now when can you grow? You can grow if you retain the money in the bank. If you retain the money in the bank, that is, if the company is earning something, please leave the money with the company so that they can grow. If you go in and take it in the form of dividend, no growth is going to be there. Classic example is your fixed deposit. Fixed deposit 1 lakh created, earn 10,000. Again 1 lakh, 10,000. Again 1 lakh. Now there are two people. One person says, I'll retain 60%. Second person says, I'll retain 100%. When I say retain 60%, on the interest of 10,000, he will take out 4,000 rupees for his expenses and leave 6,000 with the bank. 60% would be retained, 40% would be taken out. So now let's take this example. So this guy will now touch 1,06,000 next year, because he has taken out only 4,000. On this he will earn 10,600. He is growing now. Interest is growing. Next year what he is saying is, into 60% he will still retain in the bank, which means 1,06,000 plus 6,360, and he is again growing. It is now becoming 11,236. You retain, you will grow. You retain, you will keep growing. The formula for growth is retention into IRR/ROE. IRR/ROE, that is, whatever you are retaining. First example, you are retaining 0%, growth is going to be 0, whatever be the IRR. Second scenario, when you retain 60%, IRR is 10%. Basically, the bank is giving an interest of 10%. So 60% into 10% will be the growth. 60% into 10% will be. Somebody wants to grow more, retain 100%. If you retain 100%, the growth will be 100 into 10%. The growth is going to be 100 into 10%, which means you can keep growing your FD at the rate of 10%. Your principal and interest income will keep growing at the rate of 10%. So the formula for growth is IRR into retention ratio into IRR slash ROE. Two different names are given. Sometimes they'll say IRR, sometimes they'll say ROE. Can we start now this question? Working note 1. Scenario 1, payout ratio of 100%. Scenario 1, payout ratio of 100%. Point number 1, payout of 100%. Payout of 100%. Payout of 100% would mean retention of 0%. Payout of 100% would mean retention of 0%. Would mean retention of 0%. Full stop. This would mean that the growth rate is 0%. This would mean that the growth rate is 0%. Now write KE equal to D1 by P naught minus F. D1 by P naught minus F. How much is the EPS they are generating? 6. EPS into payout is what you dividend. EPS into payout. I earn 6 rupees and I pay out 6 rupees. That is payout ratio of 100%. So equal to 6 by, what is the current market price? 6 by 60, 10%. 6 by 60, 10%. Any doubts on this? Scenario 2. Payout is 40%. Scenario 2, payout is 40%. Payout is 40%. Now write growth equal to retention ratio. Growth equal to retention ratio into IRR slash ROE. Growth equal to retention ratio into IRR slash ROE equal to, what is the retention ratio? 60% into, how much are they earning on investment? 15%. 60% into 15%. 60% into 15%. So growth is 9%. Growth is 9%. Okay, now please listen. I'll have one adjustment to be done. What is the EPS the company has earned? 6. Now dividend will not be 6. We are paying out how much? We are paying what percentage? 40%. So now please listen. Dividend is going to be, wait, 6 into 40%. Now wait. The 6 into 40%, I have to technically take an assumption. What is assumption is, are we going to pay this 2.4 for the current year, or is it for the next year? When I say current year or next year, the concept of finance is that, though I call it as D0 and D1, it is technically means distant dividend and nearby dividend. What is distant dividend is dividend which will take another 5 to 6 months. Nearby is dividend which will be paid in the next 1 or 2 months. So if this 2.4 going to be paid in the next 1 or 2 months, it is D0. If it's going to take some 6-7 months, why will it take 6-7 months? Year got over in the month of March. You prepare your audited financials, that takes away some time. Auditor, then board meeting is held. After that, finally AGM is held, and then you declare the dividend after approval. It goes on till September. After September, the payout will happen only in October, November. Then that dividend is technically called as D1. Even if it is for example, in the month of March, the dividend for 2017-18 in the month of March 2018 is called as D1. Why D1? Because it will take time, another 6-7 months to be paid. So that will not be very clear in the question. So wherever there is a confusion, we will write, it is assumed that dividend of 2.4 is current year dividend in bracket D0, is distant dividend in bracket D1. So I'll write this note in some time. So why I was explaining this is, this 2.4 has to be added by a growth of 9%. You have to add a growth of 9% divided by 60 minus 0 plus separately 9% growth. Dividend will not be 2.4, dividend will be 2.4, another 9% added to it, because dividend also will keep growing at the rate of 9%. So 6 into 40%, add the growth rate of 9%. 6 into 40%, add the growth of 9%. How much is this? Now this is 2.616 by 60 plus 9%. This is 4 point. Any doubts? Okay. Can you proceed? Now you can note, it is assumed that dividend of 2.4, it is assumed that dividend of 2.4 is nearby dividend. Dividend of 2.4 is nearby dividend in bracket D0. 2.4 is nearby dividend in bracket D0. Nearby dividend in bracket D0. Can you proceed? Till what time normally your second session extends on Saturday? I have heard it as 12:50 or 1 o'clock. It goes on. Till what time does it get extended? Is it 12 or 12:30? Every day 12? I have a doubt, because when I checked with Charanya last time, she was saying that the first economics went on till 12:30 types. Can we extend till 12:30? Yes, no. Okay, we'll do one more problem and then end it. Leave it. Lenovo i3
yoga.
Okay, let's do one more problem and then end today's session. Let's go through question 17. 17. Okay, a share of X Limited, question 17, which has no external financing, is selling for 50. The EPS is 7.5, of which dividend is how much? 60%. So the company is paying dividend. It reinvests its earnings at the rate of 10%. So that is technically called as IRR/ROE. Let's first calculate the growth rate and dividend. Working note 1, calculation of growth rate. Calculation of growth rate. Calculation of growth rate. Growth rate equal to IRR into retention ratio. Growth rate equal to IRR into retention ratio. IRR into retention ratio equal to, what is the IRR? 10%. Retention 10 into 40%. 10 into 40% equal to 4%. 10 into 40% equal to 4%. Next, dividend equal to EPS into payout ratio. Dividend equal to EPS into payout ratio. EPS into payout ratio equal to 7.50 into 60%. 7.50 into 60%. You get 4.5. It is assumed that this is D0. It is assumed that this is D0. Assumed as D0. D1 equal to 4.5 plus 4%. 4.5 plus 4%. 4.68. Now put it in the formula and get the answer. $4.68 divided by P naught is how much? 50. Growth is 13.36%. Clear? Any doubts in this? Done? I'll end it with this then.